Are you looking for a new investment opportunity that is perhaps something outside of stocks? I mean, I love dividend investing. I love, getting dividends every single month. But as of late, the stock market has been really difficult. With inflation, geopolitical issues, whoever is tweeting something, it makes the markets go haywire so quickly. And I was looking for a way to invest my money that is not as correlated to the stock markets, but also earn dividends, also earn that passive income, without worrying about what direction the stock markets are going, up, down, sideways, whatever. And I reached out to my good friend, Brian and his team at Spark Rental, and we've come up with this presentation on real estate syndications. So I want to explain to you what real estate syndications are, how it works, and the benefits of it, and why I am so excited. So here we go. All right, so we're here with Brian Davis, Denny Suplee, and Tara Scott. These wonderful folks are from Spark Rental, and they are all career landlords who've been hiding this secret from me all this time. We've known each other. It's like, look, as I said before, for this year, 2022, I hate stocks. I hate the stock market.
It's been a rough ride.
Yeah, hasn't it? You have inflation, you have rising rates, you have the war, you have all of this stuff that just seems to be, just layering one thing on top of another, and all of this bad news has translated into some of the worst returns that we've seen, at least in the stock market in a long time. And while I have always been a buy and hold investor, and I still am, and no, I have not sold anything, I have also this year not made any new investments, and it's sad because it goes against everything that I talk about, right? I always say, like buy low, sell high, right? But it's easier said than done. Psychologically,
no question.
That's really tough. And what I really love about this, about real estate, or at least what the folks at Spark Rental have talked about, is the fact that we can get passive income, and we can do it without the giant gyrations of valuation that we see every day in the stock markets. So we can focus more on our next investments and what we're going to do with that passive income, rather than focus on how bad is the stock market going to be today. So
I just want to interject. It's what I'm seeing around me is kind of sad, because I'm seeing a lot of us, I'm older than y'all, and I see a lot of senior citizens now that have to work hard at a time when they shouldn't have to be. And I think something like this makes people think, all right,
right. Now, if you're watching this today, just remember, this is an introduction to real estate investing for like the average person. We're going to have a webinar early next week. You can check the link in the description below, and then come to it. You'll learn a little bit more about what we're doing, and then make the decision for yourself as to whether or not you want to continue with it. So I guess without further ado, Brian, do you want to maybe explain to us what real estate syndication is?
Absolutely. And that's an important distinction, is that most people, when they think about real estate investing, they think about directly buying properties, right? Like going out there and flipping houses or buying rental properties. It's very hands-on. It's a lot of work. You have to line up financing. You have to work with contractors. So there's a big time investment, even if you know what you're doing, and novice investors obviously don't know what they're doing. So there's extra time investment in learning the skills that you need to do it. And direct investing is something that we talk a lot about at Spark Rental. We are passionate landlords, and we do invest directly in real estate. But what we're talking about today and on the webinar next week is about passive investing in real estate. So real estate syndications, where you don't actually have to become a landlord or flip houses or mess with loans or contractors or tenants or toilets or any of that stuff. You just
Tenants
invest
or toilets.
or termites.
Brian, did I ever
Yeah,
tell you
so
about that property that I had, and I had a hoarder living? Like,
I think you did
how do
actually,
you
and
deal
it's
with
those
that?
kinds of nightmare stories that, which is why I like passive investing.
Yeah.
So real estate syndications are big commercial deals, apartment complexes or self-storage facilities or mobile home parks or whatever it is. It could be industrial property, office space, and the person who finds the deal doesn't have the money to cover the entire deal, right? Because we're typically talking about deals that cost millions of dollars. So they go out, they get a commercial loan to cover 60-70% of the costs of the deal, and then they still don't have enough cash in their own bank account to cover the rest. So they turn and raise the money from passive investors like you and me, people who just want to write a check, or in the 21st century, send money by ACH or wire or whatever, but just want to passively invest some money in the project, don't actually want to be involved in the day-to-day management or going out and finding the deals or any of that stuff. So real estate syndications, to put it simply, are just commercial deals where the public can invest passively for a fractional ownership in the deal. They're private equity deals, basically.
Interesting. And where do you suppose, how much does one, what are we talking about in terms of an investment? Like $50, $1,000, 50,000, 100,000? How does that, where would a normal investor just, where would they fit in that spectrum?
So that is one of the big downsides of real estate syndications, is that the minimum investment is typically $50,000 to $100,000. So bear in mind that real estate syndications have historically been for the rich. And in most of our regulatory history in the US, they've actually only even been open to accredited investors. Now they changed the regulatory rules a little over a decade ago to offer more options for middle-class investors, non-accredited investors, to access these. But historically, these have been for the wealthy, and even today, even the ones that are open to middle-class investors, that $50,000 to $100,000 minimum investment is a big hurdle, right?
Sure.
So next week in the webinar, we're going to talk all about how to access these with less money, because most of us, most middle-class people, don't have $50,000 to $100,000 just sitting around collecting dust, right?
Right. Well, so not only that, even if we did, right, the question becomes, if you're not used to real estate syndications, or if you're not, if this is not something that you're, that you've been exposed to a lot, you may not want to put $50,000 or $100,000 towards.
It's outside your comfort zone.
Yeah, of course.
Yeah, it's new and scary.
Right.
Yes.
Especially if you look at your portfolio, an average retired person's portfolio is going to have, position sizes, somewhere between, perhaps $15,000 and $50,000 for one position. For an average person. So saying 50,000 would be, on the high end of that scale, and if they're not familiar with it. So this is being able to start at a much lower amount would be, I think, a benefit. Yeah.
So we're going to cover in the webinar how to invest with as little as $5,000 in these real estate syndications. Now, that still might sound like a lot to the average middle-class person, and it is, but it's a lot less than the typical minimum investment, and it's still a lot less than the down payment you would need to go out and buy a rental property on your own. So that typical $50,000 to $100,000 minimon for syndication, as down payments for rental properties.
I think it's a great step for especially newbie, somebody who's newly getting involved in investing in real estate, because they kind of get to see how it works, but they don't have to deal with some of the tricky parts on their own.
Sure. Because,
and to your point, Rick, it helps with diversification when you can invest, $5,000 in a deal, $10,000 in a deal, to spread your money among many, many more deals. Because some of these are going to be home runs, some will be singles and doubles, some will be strikeouts, right? So you want to diversify and spread your money among as many investments as possible.
And in my mind,
especially during,
go ahead.
Sorry, I'm just saying, especially during these times, retirement isn't as easy. You know, no one has a retirement plan. So it's a really good way to set yourself up too for the future.
Right. That's a really good point. What I'm thinking in my mind is not only, see, I'm all about trust because, you know, if I'm going to send my money away, you know, I'm hoping that some's going to come back at some point. There's going to be a certain return that I will expect.
Of course.
Not only that, but I also want to know that I can work well with that company, because it sounds to me like these investment companies that are accepting funds on behalf of investors like you and I mean, these are people that we're going to have a conversation with at least once a year, perhaps a little bit more than that. So you want to be able to make sure that you can work well with these folks. And by spreading yourself at the beginning, if you're just getting started investing in real estate this way, you can figure out, I imagine, what companies you like and what companies you don't, so that you can in the future gravitate towards these sorts of companies.
Absolutely. And that's something else that we are going to cover in the webinar next week is how to vet syndicators, because they're not all created equal, right? And you know, you hear these horror stories about syndicators taking your money and running off to Mexico, you know, which obviously doesn't happen often.
I haven't, but now I'm afraid. Now
well, right.
I'll add that to my list of due diligence.
Yeah, exactly. Do they like margaritas? But yeah, you do need that trust if you're going to be writing a check for thousands of dollars to a company who don't already have a relationship with. You need to vet them carefully. You need to know how to vet them carefully, what kinds of questions to ask.
Yes.
So yeah, that's something that we'll cover next week as well.
Wonderful. Now, what sort of returns can one of us expect? I mean, is this a monthly play? I mean, we talk about passive income, about generating, you know, kind of like dividends on a monthly basis. What kind of returns can we expect?
So that's a great question. And the answer is a little bit more complicated than you probably were expecting. But these typically offer some returns in the form of cash flow distributions, you know, the equivalent of dividends, and then some returns at the end when they sell the property. So usually these earn in the 5 to 8% per year range on yield in either quarterly or monthly distributions. And then you get a big paycheck at the end of, it's typically between 3 and 7 years holding period for these properties. And then they sell the property at the end and everyone gets a big paycheck. So when you combine the cash flow yield and the capital gains at the end, you're typically looking at between 12 and up to 120% annual returns or more, depending on some of the really big home run deals. But for your typical deals, you're really looking at kind of 12 to 24% annualized returns. These are measured in internal rate of return, IRR. But you can, as a shorthand, we can just use annualized returns.
And that's including the exit.
That's including the exit.
Once the property is.
Yeah, for just yield, you're usually looking at 5 to 8% annual yield while you hold.
That's very solid. You know, that's, you know, sure, interest rates today are going up, so you could invest in bonds, but this way it gives you the best of both worlds. You get both income plus you have capital appreciation in the future.
Absolutely. And yeah, if you look at historical returns on stocks, the S&P 500 has an average annual return of around 10%, going back since its inception in 1926. And of that, 2 to 3% is yield, typically dividend yield.
Sure.
So yeah, these deals you absolutely can and should be beating in the S&P 500. And if you look at foreign stocks, they have not historically performed as well as the S&P. So, you know, European stocks over the last 40 years or so have averaged in that 7 to 8% annual return range, including dividends.
Sure.
So yeah, the goal with these syndications is to beat the stock market.
Yeah, no, totally agree. And I think what really makes me feel more excited about this is that with this particular, if I were to make an investment, and by the way, I will be, this is what I'm doing with my money in 2023.
There you go.
When I invest, what's going to be interesting is that I don't necessarily need to care what direction the S&P 500 is going, or what Mark Zuckerberg is doing today, and or what some political person is decided to tweet or whatever, and is sending the markets for gyrating. So this is definitely something that I like. But on the flip side, with the stock, if I do need the money, I can call my broker or go into my brokerage account, hit the sell button, and then literally I have the money in my bank account. Tell me how does it work with divesting in a syndication deal?
It's another great question. And with real estate syndications, these are long-term investments. So you do need to plan on tying your money up for up to 5 years, 7 years on these. There is no liquidity. Once your money's in, that's it.
There's no sell button.
Committed. There's no sell button on these. And so that the flip side of liquidity is volatility, right? So that's the trade-off that you make with any investments. Stocks are extremely liquid, and that makes them extremely volatile. People can buy and sell them at any moment. Real estate is not liquid at all. It's very difficult to sell in general, just as an asset class, which makes it much more stable than stocks and stock prices. So yeah, that's the trade-off you make is liquidity versus volatility.
That is a really good point. Brian, I have never actually thought of it that way. Volatility is a factor of liquidity. How fast can you sell something if affects the volatility of an underlying asset? Never actually thought about it that way. Makes perfect sense.
Yeah, and volatility is one measure of risk. It's not the only measure of risk, but it's when people talk about stock risk, for example, volatility is the main one that they talk about. So, something to keep in mind as an investor.
It comes to mind, in terms of volatility, one of my most popular videos on YouTube is about selling put options, selling put options to make weekly income. And what's interesting about that is that we use volatility to our advantage to be able to earn this extra income.
When it goes well.
Well, in a bull market works perfectly. Right now, it's a little bit more of a wait and see. I mean, you might be wanting to be on the opposite side and selling covered calls, for instance. Right now, that'd be a much better idea. So tell me more about, okay, so we've talked about volatility, we've talked about diversification. What about tax? How are the distributions taxed, or how is the whole deal taxed?
It's another excellent question. So one of the huge advantages of investing in real estate is the tax advantages, the tax benefits that you get. And with real estate syndications, you get almost the exact same tax advantages you get from directly owning properties. So you get all of the deductions, right, that the typical real estate owners get: loan interest, closing costs, repairs, maintenance, all that stuff, property management fees, property taxes, insurance, et cetera, et cetera. You also get to take advantage of depreciation, which is the big one. When you buy a property, you can write off the cost of the building itself over the course of 27 and a half years. So it's a type of deduction, basically, where every year you get to deduct 1/27 and a half of the cost of the building itself. Not the land, you can't depreciate the land, but the building, because the theory goes that buildings are physical objects and they deteriorate over time, right?
Eventually, you'll need to bulldoze it.
Right. So you can
unlike
you can
they do
the
here,
value.
Unlike here in Italy, where they last for like 500 years, and even then, if it lasted 500 years, then they have people keep them.
That's right. So you can, but these properties aren't actually falling apart after 27 and a half years, right? So it's a paper loss that you take even as you're earning money and cash flow on these. So with real estate syndications, what they actually do in most cases is they accelerate these by doing something called a cost aggregation study. And they try to change how the property is categorized tax-wise to be able to be depreciated over a shorter time frame than 27 and a half years, because they're holding these deals for 3 years, 5 years, maybe 7 years at the most. So they want to depreciate as quickly as possible, right? So they'll recategorize things like appliances and other components of the property so that they can depreciate them faster. So what happens, the upshot of all this for you as a passive investor in syndications is you'll start earning cash flow within the first year, but you'll get a K1 each year showing a paper loss. So even though you actually collected money, you're going to show on your tax return that you lost money. Yeah,
Love
that's
it.
pretty good.
Well, this is Brian, what I was telling you, this is the difference between syndications and REITs, because I was mentioning that, and you don't get those benefits. Somebody in the Facebook group actually asked, is syndication and REITs the same thing? But REITs, you actually own that property. You still own the property. You're just not.
With syndications. Yeah, we're all fractional owners
of
these syndications.
You're not actually sitting there and putting your hard work into it, but you still own that property. So you still get those tax benefits, right?
You still get all the tax benefits.
Right.
So you can use these paper losses to offset other sources of passive income, such as income from dividends. Rick, I know a lot of your audience they're big on dividends from stocks. So you can offset that income with these paper losses on syndications, or if you don't have any other sources of passive income, you can just carry those passive losses forward to the next year or the next or whatever. And then of course, when the property sells, you get a big paycheck, right?
Sure.
Everyone gets paid out for capital gains, and you can carry your losses forward up to that point to offset those gains when you sell.
Oh, that makes perfect sense to me. Because as you said, Brian, yes, I love dividend stocks. I love, the dividend aristocrats, the dividend kings. These are companies that, that during these times you want to own because you don't really have to worry about them so much going bust.
Super stable.
They've been through all of these economic cycles before. They've been through inflation. They've been through, through wars. In some cases, world wars that are much more serious than what we're facing right now. So that's why I definitely like, those type of stocks. And hearing that these paper losses on a real estate syndication deal can help offset those dividends makes it even more advantageous, because really at the end of the year, it just means that I'm going to be able to keep more of my money. And that, who doesn't?
Absolutely.
Actually give me a like on this video if you want to keep more of your money. Definitely. So to me, this seems like a perfect alternative to investing in the stock market, because it allows me to, as you said earlier, send an ACH and not really have to worry about all of the day-to-day upkeep. I don't have to worry about the day-to-day returns. I don't have to worry about the value of the properties. Tell me, how does, inflation right now is in the news, right? What does inflation have to do with real estate syndication deals?
That's one of my favorite things about real estate is that, you can't say that anything is inflation proof, but real estate is as inflation proof as it gets because it has inherent value, right? It has real, true value in the real world, in real life, IRL. So people will just pay the going rate for it in whatever currency that is, whatever the currency is valued at that moment. People will pay the going rate because they need a place to live.
Well, that's what I was saying to Denny earlier, is as inflation increases, so does the value property, the value of the property. So it's the perfect hedge against inflation.
Yeah. So one of the primary drivers of inflation is rents, and the value of apartment buildings are directly derived from the rents, the rental income. So
You're right.
as So rents go up, it drives inflation up. It also equally drives up the value of apartment buildings. So it's a great way to protect against inflation.
It's beautiful. Brent, what are we going to be talking about as a recap for next week in our webinar?
Yeah, so we will first of all talk about how to invest in real estate syndications as a middle class investor, as a non-accredited investor. If you're not familiar with that term, accredited investors are basically wealthy investors, net worth over $1 million. So that's the first thing, because we all want to invest like the wealthy do, but that has historically been very difficult with syndication. So we'll show you how to do that in the webinar. And we will also talk, like we talked about earlier, we'll talk about how to invest with $5,000, $10,000 per syndication instead of the typical $50,000 to $100,000 minimum investment on these. And we'll also talk about how to vet real estate syndicators, how to vet real estate syndication deals, what you need to know about that. And we'll dive a little deeper into some of those tax benefits as well.
And I think we're also going to talk about a real estate investing club that you have available, right?
Yes. Yeah, that's an option on the table for anyone who wants a little bit more hand-holding, wants people to propose specific deals to them to invest as part of a tribe, basically, a friends and family tribe, to help them get over that hump, with the first few deals, or just spread their money among more deals indefinitely moving forward.
Great. Well, is there anything else that I've forgotten to ask you about real estate syndication, at least on a super high level?
I'll tell you what, one of the questions that we get all the time and that excites me about real estate syndications in this moment is that they perform better during recessions than most other assets, things like stocks, for example. And I know recessions are on a lot of people's mind right now. There's a lot of concern that we will be experiencing a recession over the next year or two, with interest rates going through the roof. I mean, that's what it takes to stop rampant inflation, right? Is sometimes the Federal Reserve has to induce a recession. So that's something that's on a lot of our investors' minds and our students' minds. It's on our minds is, how do you protect against a recession? So we can talk about that in the webinar next week as well, how real estate syndications can help protect you from downside risk of recessions. But the upshot of that is that rents almost never decline during recessions. Home prices can decline a little bit, but they certainly don't decline the way that stocks do leading up to and during recessions. And certain types of real estate investments actually perform really well during recessions. Things like self-storage facilities. When people lose income, they downsize their homes and they put their stuff into storage, right?
Right.
So we can talk about
They all
that
move
in
in
the
together.
Yeah. We'll talk about recession-resistant investments in real estate as well during the webinar.
This is exciting. By the way, folks, link in the description below for details on the webinar.
Yeah, it's totally free. We're going to sit down and chat for an hour about exactly how these work,
Great,
how to access them as a middle-class investor, and what you need to know.
Well, Brian, Denny, Tara, thank you so much for the education today. I am super excited. Can't wait to get started. And I'm sure I'm going to have 1,000,001 other questions for you guys then. And by the way, if you guys have any questions, let me know in the comments below. I love to, to read and respond, and I always get back to you.
Rick, this was so much fun. Thanks for having us on.
Yes, thank you very much.
All right.
Thanks, guys.
Well, we'll see you next week. Take care.
Bye-bye.
Bye now.